So we've got turned off the waiting room, David. So people are just going to come in, and I don't have
Right.
to let them in. So there's a few people joining, but yeah, let's get started, David. So thank you for sort of us working together on this. I think this is going to be a first of many sort of collaborative sessions between Change GPS and EXL Cloud. And you and I have been working for quite a number of years together in the virtual CFO space, and then of course now in this new world of tech for accountants and bookkeepers.
Definitely, mate. Lance, thank you very much for having me here. I can see a few people on who are Change GPS users, Todd Woods and Uni and Paul Talkington, who everything going well. Paul's going to make a meme out of this webinar, so that's what success is defined by for us. And for those who've been sort of following myself or Lance over the years, we've always spoken about advisory services and CFO advisory. And in Change GPS, I've done many webinars on cash flow advisory. There's always been this disconnect between what we can talk about and what we intuitively know what our clients want and what we're actually able to deliver. And at best, we get software that can do a lot of the work, and we need to work out how to package it up. So today, Lance might share the screen and go through the agenda of what we're going to get done today.
Sure.
Today, we're going to go through a way to productize cash flow advisory. We're going to go through how the firms structure cash flow advisory services. I'm going to talk about the net profit benefit for structuring the services. 4 types of cash flow advisory. This is the key one, because I think when we talk about advisory, it's easy to get overwhelmed high manish. It's very easy to think that cash flow advisory is either something very simple, just a quick back of the serviette, or something very complicated, a big 3-way model that's big and complicated and scary, and you don't really use it enough, so you kind of forget what's in it.
Who builds those, David?
You build them, Lance. You build beautifully complicated models that I love sinking my teeth into. How to educate your clients on the value of a cash flow plan, because sometimes clients will ask a question, but they don't necessarily want the answer to be put into a piece of work that they need to pay for. Why you shouldn't answer the quick cash flow question over the phone. I hate this one. This steals your time. Sure, part of it's part of caring and delivering a service, but this eats up your margins. And then Lance is going to take over and deliver something that I think has been missing from the cash flow conversation. Is once you go through those low-level cash flow services, you get something a bit bigger, a bit juicier, a bit meatier. How do you actually deliver a bigger cash flow project for some of your best clients? This is where scope creep can really get out of hand. But if you manage it well, if you follow the process Lance is going to run through, you're going to be significantly better off and have a de-risked value proposition for clients, Lance.
Absolutely, David. I mean, I learned the hard way when I started Model Citizen, building models and getting completely blown out of the water on scope creep. And it's just something that is really, really difficult to manage. So yeah, all good. Okay, David, next slide, I guess.
Yeah, you're driving the slides, mate. I'm just talking. So the first bit of advice we want to give, Change GPS believes in 3 things. You deserve more time, more love, and more profit. And a key way that you can get more time and more profit is by systemizing your practice. GPS have got about 20 different, 15 odd different service systems. And one of them is our cash flow advisory and pricing system, which is what we're going to be talking through today. I'm really going to focus on the 4 types of cash flow advisory, level 1, 2, 3, 4, and having this structure in your head as a tool that you can recall next time your client calls up and has one of these conversations with you, you're going to have answers to it. We've also got in Change GPS emails that you can send out to clients so that they're aware this is a service that you offer. I wonder if any of you have sort of had this situation where you've started helping a client, they've said something, I didn't know you did that. I thought you just did tax. I didn't know you could help me with that. That's why I went to a business coach. The only way you can solve that is if you're the person who educates the client on what's available and what you're able to deliver for them. If the key part of the system that you do is that your staff need to be trained in it. Again, one of the problems with this sort of business advisory, cash flow advisory work is that it's in the domain of the partner and the senior leaders. Expensive time to hit WIP, expensive time to recover, expensive time to make significant money off, especially when, particularly in firms who are new to this, you're probably making really good money through your tax work. So you can want to do this, but maybe you're held back because tax work pays a little bit better than this is, but this is the fun work. It's the sexy work. This is the work that maybe makes you a bit like one of those accountants in finance or out in corporate world. And so I've got to ask this question: what would you do if staff knew how to handle a cash flow inquiry? Imagine staff knew how to price, how to scope, how to deliver, and you just review the work, make sure the client was happy, do what you really want to do, take the client out for a nice lunch after the project's finished. How good would that be? Sounds like a nirvana, but the systems that we have in Change GPS allow you to do that. And EXL Cloud as a tool with its advanced workbooks will show you how you can do it as well. So Lance, we're going to go through the system and then we're going to show some of that cool stuff in EXL Cloud later in this webinar. What's on the next slide, mate?
Don't be overwhelmed, David. I think that's the key thing. It's really difficult, right? It becomes very overwhelming because there's so many things that impact cash.
You've traveled Australia training chartered accountants, 4 chartered accountants on cash flow advisory. How often do you see a bit of fear in the room when you're talking about it?
All the time, David. I think this is the biggest challenge with cash flow advisory is because it's super difficult to get comfortable in a space that is inherently vague, right? It is. You know, there's so many things that impact cash, from revenue to cost, to growth, to capital raising, to funding, to interest rates, to pricing. I mean, I could go on forever. I mean, the models that we've built, yes, are complex, but I mean, they're there to solve so many different problems. And that can be overwhelming in terms of how do I actually answer this question and how do I manage the process? Because it is, I often see the fear in accountants' eyes when, yes, I think initially there's excitement. There's a lot of, oh, great, I'm going to get into it. I'm going to build some models. But because they don't do it often enough, suddenly that excitement turns to fear and overwhelmment and margin erosion and potentially reputational damage. And, you know, it can go on.
Great to have Michael from Future Advisory joining us. G'day, Michael.
G'day, mate.
G'day. Jack Dixon's on the line as well, always looking cool. Carlo, the coolest accountant I know, probably. Don't tell Jace that, Michael. Jace might be pretty cool as well.
It may or won't. It'll be a little secret.
Our little, yeah, just our little secret.
Just on YouTube.
I like having this as a meeting. It's pretty cool. So the 4 types of, the reason we came up with the 4 types of cash flow advisory, actually came up with this during COVID when accountants were just overwhelmed with trying to work out, can my client survive? And it's actually rung true all the way through, and people are still doing it. John Hopkett still recovering from a major time blowout on a model I built for a client last year. And John, in your opinion, jump in the chat, do you think that was a well-scoped model? Keen to hear. So I reckon there's 4 types of cash flow advisory: the quick cash flow chat, the one-way cash flows report, an actual versus budget, and then data-backed decision-making. The cool, the sexy, the Lance Rubin dominated part of advisory work that in reality, there's actually only a handful of clients in any given practice who's needs it and is happy to pay for it. That brutal combination, needs it and happy to pay for it. They're going to be the best ones that do this. So Lance, let's jump in. Let's have a look at what the first one is, the quick cash flow chat. So this is a quick conversation, and it's usually around ATO arrears. This is usually where it starts. I can't pay, or can I pay, is a question that gets asked. It's a quick convo, and the tools that you're using to solve it, you're looking at jumping in the Xero file, looking at a live balance sheet, hoping it's as reconciled or as up to date as it possibly could be. You're jumping on a portal and you're having a convo with the client. Hey, what are the 2 or 3 big things you got coming up that you know about? It's literally back of the serviette. You're using your skills interpreting a balance sheet to understand what could be happening. This is really good for small clients. Actually, like sort of those small service provider type clients where there isn't a lot of movement. They don't have stock days. Maybe they've got some debtor days, but cash flow is within the skill set of a reasonably trained public accountant to be able to, you know, balance sheet analysis is reasonably within your skill set. And I actually reckon anyone at this level can do it. If you've finished the CA program, I reckon you've got the technical skills to be able to do it. You may not have the client relationship skills, which is a problem that we all see, finding staff who can able to do that. But really what this is, I think, in the bottom line here, you're a sounding board for clarity of tax payments. This is really usually where this one starts. Work that might spin out of this might be engaging with the client for you to negotiate payment arrangements with the tax office on their behalf. That is still a significant amount of time. I don't hear any stories of anyone spending less time on hold than they did 10 years ago when I was doing that sort of work. Getting recovery for that is extremely challenging. So, I sort of think that negotiating a payment arrangements, it's the same amount of work as applying for a bank loan. I think of it like that with my mental model when doing it, and that might help you with pricing for it. So I think with this, you have high profitability risk. Clients don't usually like paying for a sounding board unless it's built into a fixed price contract. I will be your sounding board and we will catch up every month. All right, fine. You're getting recovery for that. But if it's not included in there, it's very, very hard to charge for this because the client thinks they're just having a conversation with their trusted advisor. If your practice doesn't have fixed pricing or doesn't have productized pricing, this is just customer service. And I've heard this time and time again, we can't charge for it. It's just the clients just expect it and that's why they come to us. If it's why they come to you, bloody charge for it. If it's that worthwhile, 100% charge for it.
And managing tax, David, I think is different to managing tax payments and cash flow. And I think that's the distinction here.
Yeah, that's right. Tax payments can sometimes be a bit messy. And jump in the chat. How many of you think that you've perfectly categorized tax payments on the client's balance sheet? And in some of the bigger practices that are on the call, do you have a consistent way that you recognize the tax payments on the balance sheet? Probably not. It can be a bit of a challenging thing to do. Every staff member's got their own way that they like doing it. Every manager's. Jack Dixon's 90% perfect. You have a very structured firm, Jack. And are you prescriptive? Do you say to your staff, you have to do it this way?
Yeah, I use the BAS payable, the one that you guys put forward. I just don't use the one about isolating debtors and creditors, this kind of stuff.
Cool. I reckon it's a great way to do it. I'll tell you what I hate, and I've seen a lot of bookkeepers do it more than accountants because bookkeepers are in the day-to-day. They move the tax payments onto the creditor list. I hate that.
The worst.
I hate it. I'm glad you said it. Sometimes I say that and people jump on me and they like it because the client likes it because they get the aged payable list. But it's to help actually work out what's going on in the business, it's a nightmare. So that's the first one, the quick cash flow chat. Sometimes you need to do it. Sometimes, hey, look, I'd like, to a second or third time, hey, look, it seems like you're getting value out of this. Can we have a conversation about turning this into an engagement letter? I'll flick you an email that shows you what it'll cover. And you can use the Change GPS email for the type 1 quick cash flow chat to help you get that. Lance, let's have a look at type 2. We'll go back to that one. I forgot about that slide. That's a doozy. Here's some of the common arguments against charging for the quick tax chats. If I look after them now, they'll be a client for life. This got completely debunked over COVID. The clients that you worked for free probably forgot about it very quickly. Way too many stories of accountants bending over their back for their clients. Then the client calls up and say, hey, I urgently need my BAS lodged, even though there's no recognition of the work that gets done. I think the clients will be your clients for life because you do a great job for them, not because you work for free. I've always done it this way, 100%, but I don't think you're coming to this webinar if you're subscribing to the I've always done it this way. You're probably here because you're looking for a change, so congratulations. You're in the top echelon of accountants. It's relationship management. I've spoken about that a bit, and I've never done it this way. Well, our job here is to give you the confidence to do it this way. I think when you formalize what you do in an informal way, you de-risk your advice. Your advice becomes written down. If it's over the phone, it becomes a he said, she said if anything goes really bad. There was a case in America recently where a venture capital backed company sued their virtual CFO because their cash flow forecast had 4 pay runs in a month instead of 5. Now, if the 5th pay run topples over your company, it was probably, the building was on fire before that happened, but it ended up getting pretty serious. It ended up getting that I think there was an insurance claim made against that advisor for making that stuff up. Getting things on paper makes a difference. It gives the clients clarity when they actually get something at the end of it, they understand they need to pay. And when you run a standard process, you and your staff get confidence in the process, Lance.
Absolutely. Okay. The second one, and I guess the one way is been a bit controversial for someone who loves 3-way models, David. So maybe even, just find out what it is.
Well, the one-way cash flow, this is sort of my preferred method because I think that most clients' balance sheet analysis goes over their heads. You kind of just need to know what the movements are. I reckon now you're not doing the back of the serviette anymore. You're looking a bit further out, 6 to 12 months. And you're probably looking at some things, a couple of scenarios on top of just tax payments. Right now in the one-way cash flow, you're probably looking at some of those working cap ratios, debtor days, stock days, creditor days. This is the basic stuff. Again, the good accountants, or I think the pass mark for an accountant, should be able to pick up a balance sheet and advise on where this is moving at this level. But it's a bit hard to do that over 12 months, over a longer period of time. Banks are starting to ask this in their submissions for small business clients, not the full three-way, definitely the one-way. And hey, jump in the chat. I'm hearing these stories more and more. The ATO is asking for one-way cash flow for payment arrangements over 500 grand. I'm seeing, maybe even lower than 500 grand, but I'm hearing a lot of stories about that at the moment. I reckon this helps with major decision-making. Can I afford to put on a staff member? Can I afford, yeah, Tracy's saying that's true. Can I afford to buy a new product? Can I afford to go to a new market? Can I afford to repay some debt? Can I afford to pay off my ATO debt early? If I put up my prices, what's going to happen? You're getting into some of that positive stuff as well. And it's just one way. It's just, we're literally looking at opening cash plus these movements, less these movements. How much cash are we going to have at the end? We're not going to work out what the EBIT is on this because that sits at the bottom of the P&L. We're not going to be able to work out what our balance sheet's going to be because we're going to run our balance sheet completely separate. And everyone knows it's fun to do this. This is the easy stuff because this is the business logic usually that drives the one-way cash flow. Mapping that into the balance sheet, I'll tell you what, I've lost days. I've probably lost weeks of my life that usually end up with a call to land saying, help me, because I can't get my one-way cash flow to reconcile in the balance sheet. GST always throws me out, by the way. Always stuff that one up. So now I just ask Lance right from the start to help me on some of the bigger ones. And you're looking at this, should the business continue? How much cash can you use for tax planning? If you put together a great tax planning plan for the client, they say, well, that's great, but I don't have 50 grand to put in a super. Oh, don't you? And then you can work backwards from that and try to work it out. I think it's really important when doing this that you limit the amount of scenarios that you will help the client produce. That's the major driver of scope creep on these type of engagements. Clients will say, what about this? Great. And then you get 10 different emails of different scenarios they want you to change. Limit the amount of variations you can do or train. You can design these to train the client to do it themselves. You have an assumptions section, it's colored. They know they can change certain colored cells. They don't change other colored cells. This is sort of taking some of the lessons of homogenization and standardization of those really big investment banker type models and bringing them into this. And I reckon, actually, if you engage this properly, the engagement risk is pretty low. These are pretty quick models to put together. There's actually a lot of templates. I mean, there's templates about this in Change GPS. That's not the hard bit. It's getting the client to agree to a scenario, one or two at the start, and not soaking up your time with variations, Lance.
Yeah, absolutely. I think simple is better, but then sometimes you go too far and you've got to sort of cover off and say, well, that's kind of more complex. And then you go back to the, full three-way and integrated model. David, the next one.
Actual versus budget. So we're getting into some CFO stuff now. You're getting into some more monthly meeting type events. You're looking at month-end financial statements with a budget versus actual. So one, you've done a budget, and two, you've taken the time at month-end to map that budget to actual. Now, at the lowest level of this, you've just banged some numbers into Xero budget, or the QuickBooks or Mob has the same equivalent, and you're literally printing the actual to budget report out of Xero. What you're charging for there is the time to sit down with the client, explain what these movements are, and drilling down a bit into transaction level and letting them know what caused that. It's sometimes the advice that you give is as simple as saying, hey, you spent 20 grand on extra design work that we weren't budgeting for and it caused the marketing budget to go out. Are you okay with that? These budgets go out because of little incremental decisions usually. The big stuff the clients know, they forget that what they're saying yes to throughout the month because they're just focusing on the business. I think senior accountants and VCFOs can do this work, but you've got to decide in your firm who is going to be advising the clients. There's grunt work to be done here, core accounting work. And some clients you might need to run a month end to make sure the actual's right if you're not doing a cash flow, if you're not doing it on a cash basis, if you're on a calls basis. But again, that can be pretty simple. Run through Xero, write down your process for month end, almost sometimes auto post your journals if you need to, get it in there. But who talks to the client? I think you should, because I reckon this is, if you're a partner, how many people are partners, by the way? Should have asked. I think I'm looking at some of the names. Most of these people are firm owners. Yeah, Jack's waving his hand. I know who you are. Todd is, yeah. Like, this is the stuff that I think you should do. This is the fun stuff. And this is where the client relationships are really solidified. like really solidified. This is when you're guiding them sort of work, but you don't have to do that grunt work. You can get staff to do it. And when Lance shows you the sort of templates he's got, it creates a safe space for your staff to play. It's pretty hard to go off track. I think this one's probably got a lower risk because it's actually a budget. It's so obvious what the deliverable is. It's about that management reporting. This is one I think's been in the market for a long time. When Spotlight came out, they really speared and led the industry on education around these sort of services. And I reckon it's a reasonably low risk. Where the risk is, if you're a small practice, I don't know how much time you've got to actually do this. You don't want to get stuck as the partner doing some of this grunt work. I know you like doing it, but it can eat up your time trying to reconcile that month end. Month end is a really good thing to get your offshore team to do if you're good at writing month end processes, Lance.
Good. Someone just requested transcripting, David, so I've just popped it at the bottom there. I don't know if everyone can see it.
Sure.
Yeah, but David, I think it's a good entry point, right? It's the actual versus budget. Yes, I'm out. How do I get back on track? Right? It's actually a good lead in to kind of the fourth one, which we're going to talk about in a moment, which is, okay, how do I exceed my budget? Or how do I stop the bleed if I'm actually falling behind so that the gap doesn't widen? And, also, interestingly enough, everyone's so focused on actual versus budget, which is a profit and loss concept, an income statement concept. What about your balance sheet? What about, capital? What about investing in the business? And so, we've got to be careful because, actual versus budget on depreciation, okay, yes, your depreciation's higher, but you've actually dumped another couple of mil on fixed assets or somewhere else, and you don't see that necessarily. There's not many people that do actual to budget on a balance sheet, let alone on a cash flow, maybe, but then
why do you need it? What scenario does a business need to know actual to budget on a balance sheet?
Oh, well, they don't, David. I mean, that's the point. But I mean, I guess it's more a cash flow. Yes, you should be, but you can't go from a P&L to cash flow without thinking about the balance sheet impacts. So that's the complexity here, because actual to budget is just an income statement, accrual-based variance.
If you've got clients that have any bank covenants about some of those balance sheet ratios, this conversation's different, because probably the reason you're doing this is to satisfy covenant reporting and the ratios that you've got in there.
Absolutely. And often that's not necessarily the financials. It's an EBITDA metric. It's plus or minus certain adjustments and whatever's in your covenant documents.
I spent 3 years as a frontline business banker for NAB doing cash flow lending, and became very aware of the tricks accountants would do to make sure that their clients would satisfy some of those debt servicing ratios. It's amazing what got capitalized. Type 4, mate. What do we got?
The top shelf, David. I guess
this is the stuff I think we all thought it would be, and then picked it up and realized, oh God, that's actually really hard. I need to learn that much software. It's going to take me how long to learn? Because what I love about EXL Cloud, getting all of this reporting and these advanced dashboards and analytics into Excel means that no one has to learn anything. You already know how to do Excel. That's why I'm pretty keen to be involved with EXL Cloud with you, Lance. I reckon this is longer term. You're going out multiple years. You're collecting a huge amount of historical information to be the starting point of your assumptions of what your forecast is going to be. You're going to go, Lance is about to go through the 5D business model, which is a really deep dive on how to deliver this level of service. I think we're all pretty good on the first three. I mean, correct me if I'm wrong. They've been around for a while. We just need to tighten our business practices around engagement and scope for it. This, to me, is yet to be really cracked at scale in the public practice accountant space, in part because there is a limitation when you use cloud-based forecasting tools. You can't just do whatever you want. You can't do your little calc on the side. You can't suddenly come up with the KPI that you want to do and quickly whip it up because you're limited by the formats that are in your internet browser. But Lance, I might hand over to you and you can talk through what the 5D approach is.
Yeah, thanks, David. Thanks for the good lead up. I guess the key thing here is actually thinking about the 5D business model. Not the financial model, the actual business model in terms of how would you set it up? What's the process you would follow? I've been following this model since I started Model Citizen 6.5 years ago. And this is exactly how we run every single modeling project, every single financial modeling project, whether it be a financial model or it's a data analytics project or something of that nature. So it's really easy to remember 5 Ds: discovery, define, design, develop, and deliver. And the important thing here is really to understand.
Is step 6 cash in the bank? Bang.
Yes, the bank.
Bang.
Yeah,
The bank.
that's it. The bank. Yeah.
High quality.
Collect, probably say, collect the cash. And I don't want to read the slides, but really the key thing here is making sure that you have these key aspects really nutted down. So the first 3 are really subject to price and approval. So, and your discovery phase is really where you try to understand the issue that you're going to have to grapple with. Probably, a 2 to 3 weeks piece of work, fixed fee, absolutely need to charge. The discovery work is not just I'm having a chat. The discovery is actually really deeper and discovering information, looking beyond just the financial numbers, looking what are the drivers, what's underneath. And really, you've got to be careful of scope creep really early. So that rabbit hole's gonna drown me. There's a really complex supplier arrangement here in terms of debtors and creditors. This is complex. I'm gonna have to spend a lot more time than just looking at the cash.
My approach during discovery is to pick up the balance sheet and track back and understand what the drivers are of the business that are hitting each balance sheet line item. In the first instance, you'll pick up a few things, then go up to the P&L and do it on every major revenue and expense line. Now, this get really complicated in businesses that have multiple revenue streams. So imagine you've got a retailer who's got physical shops and online. The drivers that create revenue for physical shops and online are very different. Online, you can probably go online and just download some, what are the standard drivers that we need to push through there? And my comment around drivers is important because I think this is when the big financial model becomes relevant to the client because they can control their drivers. You can say to them through this work, let's go back to that online store, hey, you actually need, based on the conversions that you get, you need 50,000 visits a month for your website to make the target revenue you wanted to make. You're at 20,000. You need to fix it. The drivers of the language, when people say that accounting is the language of business, I never really think of tax. I think of understanding how business drivers impact P&L, cash flow, and balance sheet. And it can take a long time to work it out. Now, some people have industry expertise. You've worked in that industry forever and you know straight away what those drivers are. And I reckon that's actually a really good way to make a lot of money quickly in this space because you can rinse and repeat a little bit. And you're not just rinse and repeating your model, you're rinse and repeating your understanding of their business.
Absolutely. So David, yes, interviews.
But Lance, 2 to 3 weeks is a long time.
Well, it is, David, but think about what you're doing. And I guess for a smaller business, you probably can do it in 1, right? But for sort of slightly bigger, there's interviews, you're gathering data, there's regular check-ins with the owner. You're going to prepare a report or a deck at the end, list possible areas of focus. So you might have, and Gavin, thanks for sharing that, a data finance facility can be really complex. David, you could spend 2 days just looking at someone's inventory finance or data finance facility and actually see, well, how are we actually leveraging that facility? What's the cost of it? What are the alternatives? And so you really want to try summarize what are the areas of focus out of that discovery. You're saying, this is what we want to focus on. These are the areas of focus. And I want to be able to give some budgetary guidance, some BG, budgetary guidance on if I was to do this, this is actually what I would potentially charge. And budgetary guidance on a model that looks at, your balance sheet, your income statement, your cash flows, your debtors facility, your pricing, could be $20,000, $30,000, $50,000, $60,000. So, go wide with the budgetary guidance. Then you go define those specific aspects once you've got that. David, you were going to say something.
Gavin's comment, data finance facility is going to be a bit of a trap for cash flow. I mean, we all know this, that this sugar hit at the start to solve all the problems. And then 30 days later, you're a drug addict.
Yeah.
Because you have to repay it. So the only way you can repay it is if you take another data finance facility. But Gavin, I'm the CEO of a MRR recurring revenue software company. So I get all sorts of junk in my email of people selling me things. There is now available revenue finance for recurring revenue businesses. They take a look at what you bill per month, less what your churn is, and they lend against future revenue. That's it.
Yeah.
And I dug deep into it. No director's guarantees. Someone's going to lose a lot of money on this stuff. That's madness. I wouldn't recommend any client take that.
So absolutely, David. I think, you know, if you're looking at those facilities and you're looking at that thing, it's you know, you've got to be careful of scope creep really early. So what are your areas of focus? What's not on the cards, right? So I'm not going to look at your debt facilities. I'm just going to focus on pricing, or I'm just going to focus on your supply chain. And then you agree that, as part of delivering the report, the analysis, the insight of what you're going to do next. Once you've got a focus area, let's say it's sales and marketing. Let's say you're just going to help them with sales and marketing and pricing and forget all the debt and other aspects. Then you go to the next phase, which is define. So you define within those areas of focus more detailed, precise driver bases on actually what you're going to do, what are your findings, what are you going to track, where the leaks in that particular process. So for pricing, are you not doing your correct full activity-based costing analysis in terms of are you pricing it correctly? Whether it's a service or whether it's a product doesn't really matter. Once you've defined that, then you go and design. So you've got your budgetary guidance, you've got this range. The model can be anywhere between $30,000 and $50,000. You then go and design based on that. And of course, all this time you're having a weekly catch-up, you're designing the model, and the model gets designed exactly like you design a house. Someone said to me, how much does a model cost? I say, well, you know, what's the price of a house? Well, it depends how many bedrooms and how many levels and how many, do I have an underground garage? Do I have a media room? Do I have a swimming pool at the back? You can see quickly a house price can vary wildly. What's the same thing with the financial model? Give them guidance, design it fit for purpose, and then keep to a fixed price because that's what they want. And that's how you repair a scope crept, badly scoped project, because you feel bad to charge them. And you actually look back to John's point, when you look back at what you've spent, you've completely blown your margin, you've potentially blown your relationship, and you haven't done enough due diligence up front. 30% of your effort should be done up front in a cash flow advisory, cash flow model project so that you de-risk the delivery.
50%.
30, a third.
Does anyone do that? Do you get any feedback when you ask a
third?
I'd like to hear a third.
Most people don't do it, David. They just go in and they start building. No one, very few people. And I made the same mistake.
Enthusiasm to have some fun with numbers.
Yeah.
Yeah, that's good. Having 30, 40%.
Yeah, good.
50%, Michael. Wow.
So I'm not talking about charging up front. I'm saying doing the effort that's involved.
By the way, when you're talking about upfront payments, these are obviously not cash flow deficient clients. You're using one of those type 1 or type 2 for those ones because they're not going to do this.
No, correct. And definitely I would be fixed fee upfront for the discovery phase. And then I would definitely be doing somewhere between 30 and 50 in terms of upfront pricing. But what I'm saying is actually doing the upfront investigation work. Many people forget that. Then we develop, and of course, make sure you stick to the design. The moment they want something that's out of the design, park it. Is it important? Assess it. Does it really need to happen? If it does, it's a change request. I'm sorry, this is a change request. You now want to add another bedroom onto this house, or you want to add another scenario, or you now want to include multi-currency, or now you've acquired another entity. That is scope creep. And don't ignore it. Don't just accept it, because you will get burnt at the end. Stop, pause, have a discussion and say, look, understand you signed off on this design. By the way, signing off on each of these phases is a really good practice. You sign them up front in terms of the discovery phase, fixed fee. Sign them up once you've delivered the report and say, okay, now I'm going to sign you up. This is the budgetary guidance. Let's go do the design work. Sign them up on the design, saying this is the design you wanted. Get them to sign it. We do a 20, 30 page detailed design scope document. And so that when they come back and you say, well, hang on, there's a change request. Well, let's go back to the design and check that. Because 9 times out of 10, they forgot.
Lance, do you have like a change request process?
Absolutely. Well, so yes, I have a process, but sometimes it depends on the client. But in terms of managing that, 100%. So that's the design. Now you want to change the design. We're going to give you an amendment to the proposal. And, that could be an email. It could be a formal letter. So yes, we have a process, but not sometimes it's a template. Sometimes it's just an email that we just say, or sometimes it's, on the live project calls, we say, okay, well, do you agree to change request? Yes, we agree. Okay, we'll come back with an estimate of what it is. And then the delivery. So once you've built the model, you then need to deliver and hold on. And yeah, really getting to some of those other aspects. So David, we're going to go through all of these things. There's some pricing. I think someone asked for some pricing. There's some ranges here. We're going to be doing this in the sort of boot camp. Let's get to tools, David. You said tools are great in some cases, but also they can be quite inflexible because the complexity is really going to be difficult in terms of catering for those different variations in the cash flow and the process. Why Excel wins. This is my favorite slide, David. Ubiquity, ease of use, flexibility, develop any solution, and it's enhanced through add-ins like EXL Cloud. There's no question that you can deal with any particular issue or any particular challenge if you're in Excel. There's a big challenge if you're using any of the other cloud reporting apps because the logic's not clear and it does become a bit of a challenge. So the quick cash flow model, for those that came to XeroCon, there's also a video on our website. You can also download it. Really, this takes you through a scenario comparison. You pull down the data. There's a combo dashboard. There's a scenario dashboard. What I might do is I can just quickly jump to it now and people can have a...
While you're pulling that up, Lance, I'll just talk through this a bit. So everything you're looking at right now is Excel. It looks as good as Spotlight reporting, probably not as sexy and funky as Futurely, if that's what you use. But because it's Excel, you've got depth, so you can pull anything you want and create charts. You can customize all the colors on here to either look like the client or your practices. And whilst we've got this advanced content as our starting templates, which Lance will show you in the moment, you might have KPIs or you might like presenting data in a way that you're comfortable with that you can change because it's in Excel. And I really want to stress that point. When you send these documents to clients, they very rarely open them up and read them and analyze them. What they need is you telling them the story of what's happening on the page. And you might want to tell the story in a different way to what the template is. You've got all of that flexibility here. That's the main reason why I like this so much. Financial storytelling is what makes clients sticky.
Absolutely. Absolutely, David. So this is the one-way cash flow scenario model. It's sitting within the start menu. We've got a bunch of other reports and models. It's just sitting here as a one-way cash flow scenario model. There's also one-way profit and loss scenario, but of course we're focusing on cash and cash flow. There's a quick master control, that we select, we click get, we get our list of Xero entities that we've got, they're already connected, and then we just select however many we want. We click pull, we pull the data. I've just got some demo data. It's pulling directly from Xero into Excel. There's a trial balance, which is cash basis only. There's a pivot table out of the box, David. I don't know of any other software that has pivot tables, and who doesn't like a good pivot table when it comes to slicing and dicing? This is multi-entity. There's Australia, Singapore, and UK, multi-currency as well. So I can actually look at different currencies. I can look at different chart names. But of course, then we have our starting base case input assumptions. What I'll do, I'll move this.
Lance, can you just do me a favor? Jack's asked a great question. It looks really accountant friendly, but does it scare clients? Can you just go back to one of those charts? Because Jack, I want to show you what you can do. You can just delete one of these. Lance, can you show how easy it is to delete one of them?
Well, you could even just hide it,
Done. And if you want to move it, you can change the size of these as well. They're literally like Excel charts.
It is Excel charts. I mean, it's all Excel charts. If I go to chart design and I want to change colors, in fact, what I'll do is I'll go to themes, right? Let's just change it to, look at these. I'm just literally flicking. So I can delete, I can literally go right click, move copy, create a copy. So we've got our scenario comparison. And, we can now say, okay, well, I don't want to show these things. I just want to show them the table. So I'm just going to delete. And in fact, we can delete all of these as well. And away we go. you know.
And if you could create your own chart based on the data that's in there if you wanted to. You know, if
Yeah,
you've got
absolutely.
the way you like to present the data.
Yeah, so there's nothing stopping you from doing that. So, you know, let's go back and we can unhide the combo dashboard.
Yeah.
And
So
you can create your own
it's actually a
scale.
critical point, Jack. It is worth taking the time to tailor it for the client sophistication.
100%. It's not just tailoring the report, it's actually tailoring the message as well. So what is it that they need to see? What are the things that are most critical? And so, you know, I want to look at the different scenarios here. I can play with each of those. Which company am I looking at? I can look at Australia, or I can look at Singapore. Again, across those different scenarios, I have a nice to easy use scenario manager. There's certain sheets that I wouldn't show them. I wouldn't show them this, but I'd talk through, you know, the different scenarios. You know, they can have a look at that. They can actually compare the scenarios live, and they can see revenue on a different basis. All of these Control P, print PDF ready, and you have the conversation and you can send it out to them straight away. And then, of course, valuation, right? There's nothing like actually understanding valuation as well off the back of some of these cash flows, and people can start to have a look at that. So if we go back to Australia, you know, we can see gross margins, valuations, revenue, or EBITDA multiples.
So you said go back to Australia. Is this a consolidation or aggregation?
This is an aggregation. We do have consolidation with proper intercompany eliminations using Power Query, but this is a pure aggregation, which, you know, in most cases is fine for most people. You can do eliminations and design your chart of accounts on aggregation. It still eliminates. It just depends on how you set up. But this is a pure aggregation. What about the headers? Do they delete? Yes, there's nothing locked here, Tracy. Everything, you know, you can delete the logo, put your own logo. You know, you could even change the name of this. So, you know, let's call this Tracy's model, right? And then that changes, you know, those headings. So we have a nice little hamburger menu here, which you can, you know, select, and you've also got the navigation at the bottom. So we're trying to make this look app-like, but it's still Excel.
You can save this file down to your desktop. You can also save it to EXL Cloud has built-in cloud saving capability. So if you've got some of those more sophisticated ones where you lose control of version control, you can save it to EXL's EXL Cloud and control version through it. So anyone in your business that needs to access it can access it through here. For some people who are using cloud-based doc storage, though, this might confuse your staff. It's really good when it comes to sharing with clients, and clients are making their own versions. It's really good for that. But I think for a lot of people, you prefer showing it down. The other really cool thing, Lance, we can print PDF.
Yes. Yep. So that's just a normal Control P, and then select PDF, and there we go.
We actually spent a lot of time on this because we had to get the formatting right so that it didn't chop off in the middle of charts. And everyone who's tried to print Excel to PDF knows how frustrating that can be. I actually think this is a really cool feature.
Yeah, so Control P, and you can see the preview. So you can see that's all right. I remember personally spending a bit of time on this. It's just, you know, the margins. And
Lance, a really cool question that we might be able to flex some of the power here. Paul Torkington, how do you show historically monthly pre-COVID and F23 year to date?
Great question. So what you're doing here is this one-way, excellent question. This one-way cash flow model by design is 12 months of actuals, 12 months of forecast. So I just selected the current months. If I want to go back to August 21 or 2020 even, right? I could select that, select my list, click X, demo company, and I can click pull, and it pulls the data. So you have got a fully selectable time series in terms of what you want to pull. You've got the particular financial year. If you've got, you know, obviously most of 30 June, but if you've got others on this report, let's just do the 12 months. But then on the performance report, you've got as many periods as you want, because it's just a backward looking, the traditional actual versus budget, which is type 3, which David was covering before. So you can definitely pull historical periods, as many as you want. And of course, you just got to watch how much data and that's just an Excel limitation more than anything else.
Really good use case, Paul. Banks want to see actual recovery from COVID. Yeah, and because Excel, you can almost write in it pre-COVID, post-COVID. You can almost list down the strategies that they did to get out of it. You can really tell that story to the bank.
Yeah, I might just pull. I'll do the performance report and just pull that, and you can see. This is pulling 24 months of data, so we're going back 2 years. So you can get all of that information and look back through time. You can look at month to month across each of those periods, and then you've got an actuals dashboard, which is period on period, prior year, current year. So you can actually see a percentage change: revenue current year, revenue prior year, percentage variance, expense prior year, EBITDA, and you can see all of those. You can see those by quarters as well. So that's just another one of the reports, but I guess that's again more of a type 3.
Well, can we just have a look at that report? I actually really like that.
You probably haven't seen this, David. We've been fairly busy in the background.
Yeah.
Creating
So talk about like client sophistication. What you've got here, this is actually really easy to see what's happening. Revenue, expense, EBITDA. You've got some really top tier KPIs along the top with really clear. What have you got? Variance. Is that variance to budget?
No, current prior. This is purely an actuals dashboard. It's exactly answering the question that Paul had.
Yeah,
how do we look at pre and post COVID? So
Paul, if the bank doesn't understand that, change banks. I don't think you're going to see anything clearer than that.
Yeah, so you can see month to month, and
that's really cool.
And you can see current and prior, and then you can, you've got a multi-select, so you can start to select whichever period you want to look at.
Well, I think it does take a bit of an adjustment when you start using this to get used to how the periods work. I think because when we use Xero and when we use all those cloud-based apps, we've got a start date and an end date. Whereas in here, we're saying, well, here's what we want to see, and we want to pull X number of months backwards. It's a bit of a change in our mental logic when using this. But because we're pulling in, so Lance, what data comes into Excel from Xero? Like if we just want to start building our own stuff, what data is dumped in here for us to start playing with?
Yeah, so great question, David. So we've got a data pool, which is just the P&L and balance sheet, or balance sheet only. Everything comes with a selection of accrual or cash. So I'll just pick up the P&L balance sheet. So here you can actually select, I want to pull accrual only, or I want to pull cash only. And what we built the one-way cash flow on was the trial balance. So here we'd use the trial balance pool because you want to just focus on cash. So we did trial balance, cash only, because then you can look at debtors, creditors, and all of the things that are impacting cash, but not pull the actual balance sheet. We've got account transaction level data that we can pull. We can pull invoice and bills. So what we could do is pull information relating to our debtors and creditors, work out our payments, and then actually feed that into our balance sheet. So we can start to sort of commingle this content together. And look, we're busy building a 3-way model in the background. It's going to come out, soon, but ultimately it takes, as everyone knows, quite a while to build that. But right now we've obviously got our one-way. Over time, we're definitely going to increase that. We've got P&L, trial balance, balance sheet, but then transaction level data as well. And then pushing as well, David, which is a whole nother story.
Hey, any other scenarios anyone has you want to see Lance model it out while it's on here? You got any current client situations that might be a bit hairy that you want Lance to have a play with and show you how it works here? Because it's Excel, you can kind of cover everything. You just got to be a bit creative. Lance, what's you got workbook usage there? What's that?
So workbook usage, sorry, David, I'll just jump back to that. Workbook usage is really giving insights into what people in the team are using. So if I'm trying to manage the team and I'm using a tool like this, you want to try and understand, are they using more of one particular report or one particular content? If you're doing cash flow advisory, hopefully they're using a lot of the one-way cash flow scenario model. If people are doing a lot of actual versus budget, then you'll see usage of that. So when I click this, I'm obviously not going to pull it because I pull all the stats from everything, but I guess you get to see who the most active users are, and what are they using, which we've got different databases. So here I have a whole range, including my own and some of my clients. But of course, people will get access to the advanced content and the data pool content, and then their own private cloud database. But that's what you will see. You'd see usage of your team of how they would be using the content in the system.
Like we've got 10 minutes to go. So Paul Torkington's asked, can you show us how to reforecast FY23? So you've got a forecast, you need to reforecast it. While you're getting that ready, can you just chuck the poll up, Lance? If you want to have a chat to Lance and the team at EXL Cloud, just tick the poll. They'll flick you an email. We didn't get your mobile number when you registered for this. So I'll flick you an email and Lance will get in touch. If you want to have a chat to me and the GPS team, just tick the box that's coming up on the poll right there. And I actually recently learned, I've got a small group, I can share it. If we don't put a box that says not now, we've found a lot of people just tick yes because the UX has this, the X here, the X at the top right. A lot of people don't know it's there. So if you don't want anything, just push the X. Now let's see, how do we reforecast FY23, Lance?
David, the best thing to do is it depends on what you're reforecasting. If you're reforecasting profit, then you'd use the one-way performance scenario model. If I was using the cash flow, I would do that. So if I had to go into, let's go back to that one-way cash flow scenario model, and let's go to our base case inputs. Let's clear. So what we would do is we'd pull down, we'd clear all the inputs. So that's the first thing I would do. When you start it comes clear anyway. So I'd copy the last 12 months actuals. So when you're selecting in the master control the particular period, so let's say you're doing it for 12 months looking back. Now I want to apply my first set of forecasts for next year. Let's start with copy the 12 months actuals and click yes. Straight away it takes the actual data and puts it in here. Now I want to do a basic uplift. So maybe revenues up by 5%, expenses by 2%. Let's apply that uplift, very high level. Let's say there's set pricing. We want to do that. And there you go. So you've got, that's the first step, David. I've now just populated the next 12 months with some baseline uplifts. But now it's not always as simple as that, right? So what I want to do is and I'm going to save this scenario and I'm going to clear. And I'm not going to clear the save scenario. So now I want to say, okay, that's okay. But actually, I want to get really granular. I want to look at Australia, and there's some particular big items and big impact that I need to think about. So it's Australia. Where's there going to be an impact? There's going to be an impact on revenue in the next 12 months. Its main income. How's that going to have an impact? Well, it's either going to be a repeat, which is a dollar amount. Let's say it's going to start in October. It's going to run for 5 months. And it's $5,000. And so I can see to the right, the $5,000 that are happening there. And then what I want to do is I want to have the same thing, but now there's an impact on Control D. So this is the beauty of using Excel. There's an expense impact. Maybe it's other indirects. Maybe it's 4 months, and maybe it's 3,000. And now it's not a repeat. Let's say it's spread. So we're spreading that cost over that period. And it's done that for me. So this is, I guess, the ability to do this really, really quickly. Now we want to say, okay, well, that's just the base scenario. I want to copy the base for others. So now I've got the base. But if I go down here, hey, presto, it's already given me best. So maybe the revenue actually is 8,000. And the costs are marginally higher at 3,200. And then maybe worst case scenario, which is the bottom, maybe that is 2,000. And maybe that is 2,500. So very quickly, I've got all of that. I've done that. And I've got my next year's forecast. If I wanted to purchase an asset, that's a good question. So let's go do that. So where am I purchasing the asset? Which entity? So let's choose the account type. Let's go.
So that's actually really useful if you've got a group that's got like an asset holding entity.
Correct.
You put the asset into that entity and runs appreciation through on the consolidated group.
Yep. So let's just do spread. Okay, I guess we're going to do it over one period, right? So it really doesn't matter. Let's say we've got September, it's 1 month, and we're going to invest $50,000. Actually, negative 50,000 because it's a cash outflow. So everything, revenue and expenses, the signage switches, but fixed assets, you got to define whether it's a cash
outflow. And if I was putting an HP on that, Lance, I'd put a liability on there as well as a loan. Yeah, well, what I would do actually, David, is I'd go current liabilities. I'd do cash advance. Maybe the cash advances start and end. So we have September 21. Maybe it's over 6 months, and let's do 50,000. Right, so I've matched my cash there.
and then it's so I'm shifting that cash to later because I've got to pay it, and then I can put in another line for the interest component.
And okay, so I do principal and interest. I do
Correct.
separately
Correct.
because- okay.
Correct. Because
So-
you might get interest, you might get interest only, and maybe
Yeah.
it's slightly different.
Yeah, Michael, you do need to manually enter repayments.
Yeah. The other option is you
What's-
literally do a calc sheet. So I go and I insert a new sheet. I just insert it.
Yeah, chuck
blank sheet.
chuck your depreciation schedule in here and just map to it.
Yeah. So just say payments,
The beauty of Excel.
and and then I do my calculations, and then let's say this is minus 1,000. Let's go Control R, and now I'll just go back to my scenario, and here negative. Actually, it's already negative, so I don't need the negative twice. And there it is. Bang. So I can put that in as I need to.
You can still leverage all of your Excel shortcut knowledges and all those little hacks we do to just
Yeah,
do in something. You can still do it.
absolutely. So yeah, you just link it to your HP schedule. Yeah, exactly, Michael. Exactly what you would do. So you can call this HP schedule.
And then you've kind of got your work paper built into the model.
Yeah.
Pretty cool.
So David, I think just quickly, just to run out because we're finishing up. People want to learn more. There's an 8-week bootcamp on cash flow advisory. We're going to go into the 5 phases much deeper. We're going to do recording sessions, full training, the certification at the end, practical hands-on. We're going to do a live example. We're going to use and build some of these tools and actually get people can ask any question sessions, bring live client issues, access to modeling content. This will be free for EXL Cloud Advanced subscribers. For non-subscribers, it's $1,000 per person. And if you're an EXL Cloud data pool, so you're not using the advanced content, it's a 50% discount off. So that's an opportunity to train the team. I think obviously we've got partners on the call. It's really about training the team to do some of this work, not just yourself. And then of course there's going to be more. There's going to be EXL Cloud Advisor certification, financial modeling fundamentals, advanced modeling in Power BI, advanced dynamic arrays and Lambda. It doesn't end, David. There's lots to learn in the world of Excel. So yeah.
Well, I hope everyone enjoyed it. I just got a text message from an accountant, Dave Anderson, who said, "What was that Excel tool you were talking about?" I said, "Mate, I'm on a webinar now. Watch your emails." I hope you liked it. I hope really we showed the flexibility you've got here, Lance. Cost of subscription from Michael.
$125 for the advanced content and $50 for the data pool. I'll bring it
How many clients in the 125 pack?
5.
5 clients.
Yeah. So 5 gives you full access to all of the content, and it's incrementally, and it's below anything else that you're paying at the moment, any of the other reporting tools. But you get the flexibility of Excel.
Paul, absolutely link it to GPS work papers. It's Excel. Like just paste any data into a blank tab, get anything out of GPS that you want in there, and you can pull it in, and it'll work. The other cool thing you can do as well, like eventually Lance and I are going to work on this, the GPS year-end work papers, we'd love to get to a space where you can push a button and it will pull Xero data into Excel and map it into the populated work papers in GPS. So we'll get there. EXL Cloud's only been in the market for about 2 months, but that's absolutely on our joint roadmap to be able to do that. I think it's a nice little saving. Now, also, if you, we didn't get your mobiles when you joined in, so I'm just going to put a link in the chat for everyone. If you do want to be contacted, we'll just put together a quick little nice and nasty Google form. Lance will get in touch with you, give you a buzz and have a chat. We think this is pretty exciting, and we're really early days in EXL Cloud, so you've still got an opportunity to shape the product. It's always the fun part when new products join the accounting technology landscape. Early on, it's easy to have a voice and get listened to, so we're definitely listening. Thanks, Aaron. Thanks, everyone, for joining us. Lance will get in touch with you. Have a great day. We're going to do these again, Lance, and I reckon what we should do, let's just say, hey, what scenarios do you want us to model? And you can just model them out and I'll ask dumb questions.
Yeah,
That's
absolutely. Sounds good.
See you, everyone.
Thanks, everyone.
Bye.
See you.